Good afternoon, everybody, and thank you for joining us this week on the Barometer Readings webcast. Today's September 17th, and thank you so much for being here with us and logging in. David Burrows is out today, and I'm here to provide you a market and portfolio outlook in his stead. My name is Diana Avigdor, and I'm the head of trading here at Barometer. I have been with Barometer and David Burrows for a very long time. I will go through some of the market makers that we are watching, some of the markers we are watching, and I'm going to tie it in with what we are doing in the portfolios. So let's begin. The bottom line for us is, and what we are most mindful of at this point, is capital preservation, and the preservation of gains in the portfolios so far. 2024 has been very good to us, and we are trying hard to keep it that way. Markets have been trying to redirect lately for various reasons that we will go through, some of them. And they're trying to find a new footing in the new setup, that of lower rates. Finally, the world's largest central bank is expected to begin a rate cutting cycle, which should help sectors that have perhaps been lagging. And the market is trying to figure out what future economic cycle it needs to price in, a soft landing or a recession. As markets are rediscovering and redefining, our desired objective is to cast the net as wide as possible in order to achieve an all-weather portfolio, while being mindful of new trends that are emerging that we can press on for alpha, without giving up stability and therefore achieving a balanced risk-adjusted return. So let's begin, and I will walk you through our thought process these days and how the portfolios reflect that. We always begin with this slide, and this is just to say that we still think that we're in a structural bull market. It says that since 1896, Dow Jones has experienced 8 structural markets. Historically, they lasted an average of 14 years, but some much longer, 19 years and 22 years. With the current global climate and for various economic and political reasons, think government's propensity for spending, for example, bull markets have lasted longer since 1990s than any other time. This one started in 2013, and we would be 11 years into it, though you can argue that perhaps we had a reset with COVID when it hit in 2020, and the counter may begin anew then. In front of you, there is the S&P 500 one-year chart. Technically, looking very sound. You can see it is above all its moving averages, and that is what technicians consider positive. But it has not been making a new high at this point, as it is awaiting some important events. Next is NASDAQ, and everybody's talking about the Mag 7, and as of late, those big cap techs have been performing, but underperforming some other sectors, which I will show going forward. I'm using 1 year for the S&P and 5 years for NASDAQ, just because it has outperformed so much, and I wanted to show how the recent month here has lost some of the relative outperformance. You will note that the S&P here is looking much straighter, much cleaner, whereas the NASDAQ does have these higher, lower lows and lower highs. So we'll see how this resolves. I mean, these are companies that are high in growth, but they have been priced for perfection for a long time. So this needs to resolve, and there are some other things that are working, which I will show you. Make no mistake, there is nothing wrong with some of the world's largest tech companies, but they rallied hard and a lot. So we'll see where the money is going these days. The last 2 weeks have been a little treacherous, and this is why I started out by saying that the market is trying to redefine itself if it has to. We had a week that was down over 5%, and then we made it right back, but have not made new highs. By way of visualization, this is the Japanese market. One of the reasons that the market did this in the last couple of weeks was triggered perhaps by a growth scare, but also followed by some global changes, such as the Japanese finally seeing some inflation in the pipeline and being the last large country to start raising rates, perhaps. And this is Japan being visualized, and you can see the topics overlaid with flows. You can see that the last couple of years, there's been fairly high interest in this market. Inflation is always preferred to deflation. Better for economies, better for companies, and companies figure it out. Increases the motivation to buy now versus later, which lubricates the economy and heats it up. Of course, everybody wants balance at the end, not overheating, but when an economy has been in deflation for 2 decades, the glimpse of inflation is welcome. Back to our local market overview. This is the NASDAQ 14 days. This looks exactly like what the S&P did in the prior chart that I showed you, down 1 week, almost fully back the week after. As I mentioned before, other things are happening in the market. The market is broadening. This is the equal weight S&P, and that one is making new highs, which the S&P that I showed you earlier was not. Other sectors outside of technology are starting to move, and that's not necessarily a bad thing. It allows you to buy things that are perhaps cheaper, have better growth prospects, although, like I said, American tech companies do have pretty high growth prospects ahead. The economic data has been coming in soft. This is the Citigroup Economic Surprise Index, and it measures the expectations versus what actually comes out. And what this shows you is that it came down quite substantially, but now has been stabilizing. And that is good news because we want to argue that we're having a soft landing. The past couple of months, things that benefit from lower rates outpaced the technology stocks and started to outperform. So the orange line is utilities, been acting very well. Real estate, as rates come down, real estate stocks have been not doing so well. Think REITs. Healthcare has been mixed. It's ahead of an election. They like, candidates, they like to toggle healthcare as one of their points to argue on how they're going to make everything better. But all of those have outperformed the tech. In our portfolios, we own several utility companies. One of them in front of you is Nextera. This is a regular utility company serving the state of Florida and elsewhere, and is also a play on renewables. It generates electricity through wind, solar, and natural gas projects. This will work well should we get a Harris presidency in the US, but at the bottom line, it is an interest rate sensitive play, no matter who gets into the White House. Another utility we own in Barometer portfolios is the Southern Company. It generates, wholesales, and retails electricity in the southeastern United States. This company also offers wireless telecommunication services and provides internet access service as well as wholesale fiber optic solutions. So lots of things. These companies have visible, predictable earnings with growing user bases. Over in Canada, we just added exposure to Hydro One, certainly one that has made it through our filter to the relative strength pages, as you can see in the chart. It sports a dividend yield growth of over 5%. And Bank of Canada yesterday said that they're going to perhaps do what they call jumbo cuts. That would be 50 beeps instead of 25 beeps, as economic data and CPI today in Canada came in much lower than the high, of course, in line with expectations, but it's sporting a 2% handle now. So inflation is thoroughly under control, looks like, and they don't want economies to slow down too much. These stocks, these utility stocks, like Hydro One, are very interest rate sensitive. They have debt, That's just become cheaper, and the 50 beep jumbo cut would continue making these stocks attractive. It again has a rate base that is growing. Think immigration in Canada, and is a good regulated utility. Enbridge, of course, we all know this company. We all pay the bills every month. 6.5% gross yield, growing it at around 5% over the last 5 years. Not bad. These are the kind of companies that are really working right now, as the rate environment is really benefiting their valuations. And so we added more utility exposure in our balanced portfolios. Bond buying, almost all more robust for various reasons, has significantly spiked up of late, as globally lower rates are expected and in some cases already materializing. These are flows out of the major markets, not just US. As you can see, the source, it's ECB, Bank of Japan, Bank of England, and US from JP Morgan. The expectation that rates are coming down has made these bonds more attractive. Like I mentioned, some lower rates in the market are already filtering through. Mortgage rates have declined to levels not seen in a couple of years. That is boosting the consumer. In Canada as well, as Bank of Canada has really embarked on a rate cutting cycle and is pretty transparent about it. We have added exposure in balance mandates to Killam Apartment Real Estate Investment Trust, known as a REIT. They operate multiple unit residential properties across Canada. They own, operate, manufacture home communities. They have about 200 properties with over 16,000 units. They have growth, but they also have a yield of about 3.5%. I just want you a long-term chart of this stock to show that it has room to grow. Because here it just looks like it's making new highs, but it's not over in the big picture. So in this environment, we feel it has lots of room to grow. So inflation is coming down. The year-over-year comparisons will also get easier. In the US, we are now around 317, down from 9%. Michigan inflation expectations. This is what people surveyed feel inflation will be in the future. Those expectations have come down. There is a funny kink in inflation, and that is that inflation expectations create a loop of self-fulfilling prophecy. If people expect inflation, they create inflation. But inflation expectations have gone down substantially, so that is a good thing. So REITs, financials, defensives continue to drive relative strength, and the relative high list, we're there. Canadian banks also continue to work very well. After a bit of weakness a year ago, we stuck with financials and we added. We added Royal Bank for its excellent exposures and management, and added CIBC as we like its domestic focus, and therefore they don't get caught up in international costly regulations. Royal Bank pays about 3.5% dividend. CIBC pays 4.3% dividend. Solid, stable, dividend growing companies that benefit from a softer interest rate environment. We also like JP Morgan in the US, the country's largest, most diversified bank. We look to the US for global diversification, whereas in Canada, we currently prefer the domestic exposures ones. I didn't put this in here, but we also own national. JP Morgan pays a 2.2% dividend, and they're mainly a global growth company. So we're looking for growth in this stock. And Goldman Sachs, we all know Goldman well. It's the world's premier money center bank. Think investment banking, think private equity, think smart traders. The US financials hit a soft spot in this sell-off that I've shown you in the beginning. In the past week or two, they have spoken at the Barclays conference and sounded some conservatism around their growth. Earnings season is coming up soon, so we'll see. But it continues to be a relative strong performer. and the top sector right up here, together with real estate and utilities. Another sector that has done really well lately is gold. It is trading at a new high, and gold analysts are predicting it goes higher as global liquidity continues to expand and the US dollar continues to weaken. We know because they tell us, but central banks have already been buying lots of gold. Investor appetite globally, however, not so much, but moving in the right direction here at the bottom. Gold companies are already exhibiting signs of investor interest, and there is already a sizable amount of M&A in the sector. Speculators, however, are right on the ball on this one. They usually are first to buy and first to sell too, but they are smelling something in the air, as you can see. Speculator exposure, according to the CFTC, is as high as it's been in quite a few years. One of the companies that we own that is gold exposure is Kinross Gold. We make sure one of the themes around our gold exposure is that we want our gold companies to be in safe, geographic, and politically stable environments. Gold and gold companies are torquey. They have torque. They rally hard, they sell off hard. We want to make sure that it's properly risk adjusted, and we want the domestic, stable exposure, even within a sector that is so volatile. Another one we own is Agnico Eagle, also domestic with operations primarily in northwestern Quebec, northern Mexico, Finland. UBS upgraded them this morning on this same theme, its stability. Earnings season, like I mentioned, is starting again soon. We'll see what the banks will report. The last one was pretty good. Year over year, we're looking at around 15% earnings growth rate overall. But what's most exciting to us is operating earnings. Operating earnings are solid and healthy, and despite all the problems, such as higher labor costs, input costs, inflation, you hear about strikes everywhere, companies do figure it out so far. Companies invest in their businesses, and they're able to pay the higher cost of employment, and they're figuring out their operating margins, as you can see, quite nicely. As long as we find companies to invest in whose operating margins are stable and growing, our portfolios will likely do so too. Bull markets, like I mentioned, have been longer since the 1990s. We just had one in COVID. I don't think we're that due for another one in terms of major drawdown. Yes, the market is trying to find its new footing, waiting for the Fed to cut rates. Some are actually saying that the Fed is behind the curve. We're going to get the Fed meeting tomorrow. It's almost, I'm going to say 100%, but I'm going to just use the word almost just in case. A 25 beep is pretty much in the cards. 50 is what a lot of people would like to see, including myself. There is a feeling out there that the Fed is a little bit behind the curve, but I understand because US has had the highest economic growth of anywhere globally, and so they're the last central bank to start their cutting cycle. It's also an election year, and we have elections soon in the US, maybe even Canada, who knows. And like I said about our Nextera, the utility company, that's also a play on renewables. Markets are in a bit of a holding pattern this close to elections, as markets don't like unknowns. But after the unknown becomes known, markets behave better. So maybe we are in a holding pattern in the indices. Underneath the surface, there's always things that work, like I mentioned, the utilities, gold. We'll see what happens with the financials when the earnings, but the Canadian banks are already working very well. We are ahead of a rate cutting cycle in the US, as I keep mentioning, because it's top of mind. Markets tend to do well after a rate cut if a recession is avoided. And that is exactly the point here for now. all the economic data suggests, both in Canada and in the US, that we are around a soft landing. Some of the data is very good. It's just off its highs, which is really what we wanted to see and what the Fed needed to see in order to start cutting rates from a very speedy and steep rate hike cycle. Now they need to take it a little bit lower. Two-year yields, this is the the bond term that is most sensitive to interest rates, have dropped substantially the past few weeks in anticipation of an FOMC cut. The question is 25 or 50. One of the stock additions has been AT&T, another interest rate sensitive, and a telco that is still expanding users. It also has an 8% yield and a significant amount of debt that will just get cheaper as we speak. And finally, a picture of our portfolios. Over the last over month, we have expanded, as I mentioned, our investment in the financials. We are overly tilted in financials than the index. We have taken down our information technology. We have taken a lot of nice profits. We have sold NVIDIA, which has done very well for us. And we're under the index quite substantially. We still own some very good tech companies like Apple and Microsoft. Microsoft today announced a dividend hike and a 60 billion buyback, approved buyback program. These are companies that are doing very well and affect our lives on a daily basis. We have taken down our energy a little bit to fund these purchases, as you can see month over month, but we're still overweight our benchmarks. And overall, bottom line, our exposure to utilities and real estate has been taken up, tilted towards interest rate sensitives as the world seems to have entered a liquidity infusing lowering of rate cycle at a time when the economy still feels good. So overall, our bottom line is that we want to make sure that we go through the fourth quarter and into the uncertainty of the election with a portfolio that is well balanced, and we press on some of the things that are seeming to work really well, like gold, some of the technology, some of the REITs, and some of the utilities. That is to summarize our position. And that is for me, it for me. I'm happy to take questions if there are any. But otherwise, I don't see any. I hope I have given you a good picture of our portfolios and where our head's at. And thank you very much for joining us. Have a great afternoon.